What if your entire financial future depended on making one wrong investment? Scary thought, isn't it? Fortunately, diversification, the ultimate investment safety net, ensures that no single mistake can ruin your financial dreams. We'll explore how you can build a diversified portfolio tailored to 2025's trends, risks, and opportunities. Why diversification matters more than ever. 2025 is shaping up to be a year of economic shifts, technological innovation, and potential market volatility. Diversification, the practice of spreading investments across different asset classes and markets, is a proven way to manage risk while maximizing returns. By avoiding putting all your eggs in one basket, you create a resilient portfolio capable of weathering storms and seizing opportunities. 1. Balance between growth and stability. Start by allocating your investments across growth assets, like stocks, and stable assets, like bonds or cash equivalents. Growth investments: U.S. tech stocks, renewable energy funds, and emerging markets. Stability investments: treasury bonds, high-quality corporate bonds, or money market funds. Pro tip: use the rule of 110 inches to determine your stock-to-bond ratio. Subtract your age from 110 to find the percentage of stocks you should hold. For example, if you're 30, aim for 80% stocks and 20% bonds. 2. Include international exposure in a global economy. Limiting your portfolio to domestic assets can stifle growth. Why diversify globally? Countries like India and Brazil are experiencing rapid economic growth, offering lucrative opportunities. How to invest internationally? Look for global ETFs, e.g., Vanguard Total International Stock ETF, or mutual funds focusing on emerging markets. 3. Don't forget alternative investments. Alternative assets provide a hedge against traditional market risks. In 2025, some key options include real estate, physical properties or rights, real estate investment trusts. Cryptocurrency: Bitcoin, Ethereum, or blockchain-focused ETFs for tech-savvy investors. Commodities: gold, silver, or energy ETFs to protect against inflation. Caution: keep alternatives at 5–15% of your portfolio, as they can be volatile. 4. Diversify within asset classes. Even within a single category, diversification is critical. Stocks: mix large cap, e.g., Apple, Google, mid-cap, and small-cap companies across industries. Bonds: combine government bonds, municipal bonds, and high-yield corporate bonds. ETFs: choose thematic ETFs, e.g., clean energy, healthcare innovation, for exposure to niche markets. 5. Rebalance regularly. Markets fluctuate, and so will your portfolio's composition. Why rebalance? If stocks outperform bonds, your portfolio may become overly weighted toward risky assets. How to rebalance? At least once a year, sell assets that have grown too large and reinvest in underweighted areas to maintain your desired allocation. Emerging trends in 2025: sustainable investing, ESG, environmental, social, and governance funds are gaining momentum as socially conscious investors prioritize sustainability. AI-driven strategies: use robo-advisors or platforms with AI-driven recommendations for personalized, efficient portfolio management. Answering the opening question: if your financial future depended on one wrong investment, you'd be taking a gamble. But with a well-diversified portfolio, your success doesn't hinge on any single asset. Diversification provides the ultimate safety net, allowing you to grow wealth steadily while minimizing risk. Ready to take control of your investments? Subscribe for more expert guides, and don't forget to share this with a friend who's ready to diversify and thrive in 2025.